It's going to be Liberation Day in America, and it's going to be a day that hopefully you're going to look back in years to come and you're going to say, you know, he was right. This has turned out to be one of the most important days in the history of our country.
Trump's Liberation Day tariffs look set to shackle global trade, threatening to upend the world economy, reignite inflation and heighten geopolitical tensions. Live from Sydney, this is Insight with me, Heidi Stroud-Watts, where we dive deeper into the story with crucial context and sharp analysis. Well, it is a sweeping sell-off in global financial markets after President Trump's announcement of a minimum 10% tariff on all exports to the US. Investors rushing for havens spooked that an escalated trade war could destroy global growth.
I would advise none of the countries to panic. I wouldn't try to retaliate, because as long as you don't retaliate, this is the high end of the number. And I think the market could have certainty that this is the number, barring retaliation.
US Treasury Secretary Scott Bessent, they're urging trading partners not to retaliate, but China is promising to hit back against a tariff rate of at least 54%. So, will Trump's Liberation Day end the WTO and force a rethink on the China+1 strategy? We have a great lineup of guests out to discuss the ramifications. Eswar Prasad is a professor of international trade and economics at Cornell University and a former head of the China desk at the IMF. And Georgetown law professor JenniferHillman will be along with us too. She previously served at the US International Trade Commission and also at the World Trade Organization. Let's get the latest right to our top story now. Markets across Asia feeling the heat after President Trump imposed that minimum baseline of 10% tariffs on all exporters to the US that will take effect after midnight on Saturday. Higher duties, of course, significantly higher for some regions and countries, kicking in on April 9th. Let's bring our team now. For the latest, our Bloomberg News editor John Harney joins us from Washington. Our chief North Asia correspondent Stephen Angle is in Hong Kong. South Asia economy editor Richie Bhatia reporting from New Delhi. And Avril Hong is in Singapore for us. And John, let me start off with you. For a lot of people, and certainly for a lot of investors, the announcements today were worse than what was actually expected.
These were all-encompassing, and by that I mean it didn't matter if you were a friend or an adversary of the United States, you got hit. That included China, of course, the chief adversary of the United States, as well as Japan, an important trading and military or important partner. Israel got hit, another very close ally. And of course, Canada and Mexico, while they were spared of today's tariffs, still have 25% tariffs imposed on them. So this all is part of an agenda that Donald Trump has had ever since he entered politics. The idea that the United States has been taken advantage of regarding trade, and as a White House fact sheet put it, these other countries have destroyed our manufacturing economy of the United States, that is.
You refer to some of the old allies there, John, and Australia is one of them. And, you know, President Trump said they're wonderful people, wonderful everything, but still a 10% tariff when Australia doesn't impose tariffs the other direction to the US, right? What are we hearing from the countries in terms of, you know, some that will retaliate, others are just sort of waiting to see how this plays out?
Well, Australia actually has a trade deficit with the United States, which is interesting. And yes, President Trump, during this White House session at the Rose Garden, said over and over how much he liked this country, that country, was friendly with their leaders, what great people they were, but it didn't matter. They all got slapped with tariffs. But Canada, under Mark Carney, the new prime minister, promised retaliation of some sort in the morning. China, just recently, in the last few hours, has said they're going to take retaliatory steps without really saying what they are. Other countries, I think, are probably trying to gauge what's going to happen next, because the full extent of these tariffs won't become final till April 9th. A lot could happen between now and then.
Steve, one of the countries already saying that they will retaliate is China. Are we starting to see the gloves come off from Beijing because they've been relatively measured until now?
Yeah, they have, and they still have a few more levers to pull in this escalating trade war. They've been fairly measured, as you rightfully said. Yes, they did respond to the first 10% that Trump added, then the second 10%. But what they haven't necessarily done is acknowledge America's complaints on the fentanyl issue, which the first 20% of the now 54% added cumulative tariffs that the Trump administration has added on China. They haven't really acknowledged it to the benefit, or excuse me, to the liking of the Trump administration. So therefore, we have that 54% cumulative tariff now. But if you dig down deeper, you also have existing tariffs on top of that. And Bloomberg Economics is saying that could be as high as 68.8%, which is even further than what Donald Trump pledged on the campaign trail, and also a number that would essentially destroy trade between China and the United States and knock about 2.3% off China's GDP. I mean, they are trying to recalibrate their domestic economy and boost domestic consumption. That's something they probably have needed to do for decades, but it doesn't happen overnight. So there's going to be some severe economic pain in China for sure. But keep in mind as well, over the weekend, you did have the trade and industry ministers of South Korea, of Japan, and China all meet in Seoul to kind of compare notes to see how they could potentially respond to what was expected. What they didn't expect, that it was going to be such high tariffs.
And, John was just talking about traditional U.S. allies, South Korea, Japan, right, being hit with these tariffs, the auto tariffs of Japan of particular concern. You can kind of see that as these are the markets that are being hit the worst in the Asia session today.
Yeah, and key allies as well, South Korea and Japan. We're already getting responses from the acting president, Han Duck-soo in South Korea, urging, to have dialogue with the United States. Han Duck-soo essentially saying this is a very serious situation. The government must pour all of its capabilities into overcoming this trade crisis, and he's urging officials to actively engage in negotiations with the United States. Japan, too. Obviously, we had Ishibe, the prime minister, talk about the possibility of countermeasures to those auto tariffs. Japan is saying that the chief cabinet secretary saying they will continue to ask the U.S. For relief on those new tariffs.
Richie, when it comes to India, what is kind of the impact that's playing out at the moment in terms of the impact of the tariffs and how potentially the government, which has been trying to sort of position favorably with the Trump administration, how they will react?
Well, the Trump administration has imposed a 26% tariff on imports from India, which is one of the highest rates that we've seen for any of the major U.S. trading partners. Donald Trump, remember, has called it a discounted reciprocal tariff, but in the past he's called India a tariff king, a big abuser of tariffs, and his personal ties with Prime Minister Narendra Modi also did not affect the decision in many ways. The Modi government, of course, had sought to avoid any new levies by offering various concessions, reducing taxes on bourbon whiskey, on Harley-Davidson bikes, and pledged more steps. But it seems that so far this has not cut ice with the U.S. government. In fact, local media reported, while there has been no official response by the Indian government so far, local media has quoted officials saying that it's been a mixed bag of sorts and not a big setback for India, because there are exemptions to sectors such as pharma and semiconductors. But for some of the other sectors like gems and jewelry, engineering, electronics, they definitely are going to be the ones that will be hit quite a lot. But net-net, it does appear that India's export competitiveness in the U.S. market stands far less impacted on a relative basis, because some of the other countries have been taxed at a much higher rate. India's competitors such as China, Vietnam are definitely hit harder, and that means that there could be lesser impact in India. Also, if I can just add one more point, it also needs to be seen what will happen now as far as the bilateral trade agreement between India and US is concerned, there is definitely an increased pressure to strike that deal as early as possible now.
Avril, as you just mentioned, the likes of Vietnam, right, where exports are equivalent to about 85% of GDP. This Southeast Asia focus is really interesting, right? Was there sort of a concerted effort to take a look at China+1 in this tariff strategy?
Absolutely. I mean, we saw how companies shifted production out of China into Vietnam as part of the China+1 strategy following the first trade war. So you can imagine how problematic now this is going to be for some of these companies that have been banking on the likes of Vietnam. You look at the absolute rates on tariffs for Vietnam, it is higher than that of China. And of course, if you look at the market reaction, it just tells you how investors were not quite positioned for 46% tariffs on Vietnam. And I think you're continuing to see some of that extension of declines in the stock markets. But if you go by Trump's logic, perhaps not that surprising that some of these Southeast Asian countries were that hard hit. I mean, you look at the trade imbalances, right? And the trade surplus that some of these nations have with the U.S. Top among those on the list include the likes of Vietnam, Thailand as well. So what this tells us in terms of Trump's move is that the charm offensive, some of these diplomatic efforts or offerings of reduction of tariffs as well as to purchase big ticket U.S. items, they just haven't worked at this point. And keep in mind as well that, as John highlighted, when it comes to the likes of Australia, which has a deficit with the U.S. Similarly, in this part of the world, we saw in terms of Singapore, it has a trade deficit with the U.S., but we still saw 10% tariffs being imposed on them. Now, when it comes to the overarching impact for the region, our Bloomberg economics colleagues have put out a really good note, and they highlight how reciprocal tariffs, or the median level, 36% for countries in the region, they actually expect the projected impact from levies to be worse than what we saw during the 2008-2009 GFC, because this time around, Heidi, China's not quite in a position to provide a sort of buffer. There could be some looking at interested economies in terms of those that are domestically driven. But overall, I think the projection is for central banks in this part of the world to cut even more so than what was expected just before Trump came to office.
Avril Hong there with Richie Bhatia, Stephen Engel and John Harney there to take a look at really the global implications and the Iraq reaction that we've had so far. And of course, we were talking about Australia's reaction with the Albanese government really expressing its disappointment over this decision, pointing out the fact that, well, if there were reciprocal tariffs that were due on Australia, then they would be zero because Australia does not extend tariffs to the United States. But of course, there are these non-tariff category of grievances, if you will, that President Trump has spoken about, which for him, when it comes to Australia, has been about not accepting American beef. And Prime Minister Albanese has said that is a biosecurity issue and not up for negotiation. But referring to that as a poor decision, Australia is one of the countries alongside New Zealand saying at this point that they will not put in place retaliatory tariffs. Well, coming up next, we'll talk more about these global ramifications for trade, for supply chains. Our panel coming up, Eswar Prasad, who's a professor of international trade and economics at Cornell University. He's, of course, a former head of the China desk at the International Monetary Fund. Georgetown law professor JenniferHillman served at the US International Trade Commission and at the WTO appellate body. She'll be joining us as well. You don't want to miss that conversation. Up next. Welcome back. You're watching Insight. Let's get some more analysis when it comes to President Trump's sweeping new global tariffs. Eswar Prasad is a professor of international trade and economics at Cornell University. Previously, he served as a head of the International Monetary Fund's China division. At the moment, though, we are just getting some breaking news when it comes to what we're hearing from Europe at the moment. Ursula von der Leyen, the European Commission president, is speaking at the moment, really, again, addressing that European reaction to Trump's tariff, saying that the global economy will massively suffer, that they regret the US decision to implement further tariffs. Let's take a listen.
the opposite of what we wanted to achieve. The tariffs will also hurt consumers around the world. It will be felt immediately. Millions of citizens will face higher grocery bills. Medication will cost more, as well as transportation. Inflation will go up. And this is hurting in particular the most vulnerable citizens. All businesses, big and small, will suffer from day one. From greater uncertainty to the disruption of supply chains, to burdensome bureaucracy, the costs of doing business with the United States will drastically increase. And what is more, there seems to be no order in the disorder, no clear path through the complexity and chaos that is being created as all US trading partners are hit. In the past 80 years, trade between the European Union and the United States has created millions of jobs. Consumers across the Atlantic have benefited from reduced prices. Businesses have benefited from huge opportunities, leading to unprecedented growth and prosperity. And at the same time, we know that the global trading system has serious deficiencies. I agree with President Trump that others are taking unfair advantage of the current rules, and I'm ready to support any efforts to make the global trading system fit for the realities of the global economy. But I also want to be clear. Reaching for tariffs as your first and last tool will not fix it. This is why, from the outset, we have always been ready to negotiate with the United States to remove the remaining barriers to transatlantic trade. At the same time, we are prepared to respond. We are already finalizing the first package of countermeasures in response to tariffs on steel, and we're now preparing for further countermeasures to protect our interests and our businesses if negotiations fail. We will also be watching closely what indirect effects these tariffs could have, because we cannot absorb global overcapacity, nor will we accept dumping on our markets. As Europeans, we will always promote and defend our interests and our values, and we will always stand up for Europe. But there is an alternative path. It is not too late to address concerns through negotiations. This is why our Trade Commissioner, Maroš Šefčovič, is permanently engaged with his US counterparts. We will work towards reducing barriers, not raising them.
That's European Commission President Ursula von der Leyen. They're speaking in Uzbekistan, delivering that EU statement when it comes to the reaction to Trump's tariff announcements. Let's listen in again.
Europe has everything it needs to make it through the storm. We are in this together. If you take on one of us, you take on all of us. So we will stand together and stand up for each other. Our unity is our strength. Europe has the largest single market in the world, 450 million consumers. That is our safe harbor in tumultuous times. And Europe will stand at the side of those directly impacted. We have already announced new measures to support the steel and cars sectors. Last week, we limited the amount of steel that can be imported to Europe tariff-free. This will give more breathing space to these strategic industries. Now, we will also convene strategic dialogues with the steel, the automotive and the pharmaceutical sectors, and others will follow. Europe stands together for our business, for our citizens, and for all Europeans, and we will continue to build bridges with all those that, like us, care about fair and rules-based trade as a basis for shared prosperity. Thank you. L'annonce du président Trump des tarifs douaniers.
Head of the European Commission, Ursula von der Leyen, there delivering that statement which really addresses Europe's response to these sweeping new global tariffs. And of course, Europe, alongside many parts of Asia, some of the hardest hit regions there. Von der Leyen saying it's not too late for negotiations when it comes to US trade, but they won't accept dumping on European markets. There are countermeasures to come if those negotiations fail, and they're preparing further countermeasures to further respond to US tariffs there. So we continue to watch and wait, but there's a lot of warning, as we've heard from a number of different leaders, about the economic uncertainty and the damage that could be done if these tariffs, in fact, come into effect and stay there. Let's get some insights now into the situation. Eswar Prasad is a professor of international trade and economics at Cornell University, previously head of the IMF's China division. Also, along with us this hour is Georgetown law professor JenniferHillman. She's a former member of the World Trade Organization's appeals body. Really appreciate both of you for giving us your time and your insights. And Eswar, let me start off with you, because for most of the people that we've spoken to, this was much worse than expected. It's interesting, Ursula von der Leyen said earlier that there seems to be no order in the disorder. What do you make of the announcements and how they play out in sort of from the short term to the longer term sort of structural implications on global trade?
So we are certainly at the beginning of an all-out trade war, and the U.S. is retreating into an era of protectionism and dispensing with the rules-based system that it played a very large part in setting up. And there are going to be reverberations around the globe, because practically every country right now, every major trading partner of the United States is being affected by these tariffs, and that includes allies as well as rivals, or friend and foes, as Trump described them. The reality that the world faces right now is that we're going to face a huge amount of uncertainty. As Madam von der Leyen pointed out, businesses are going to be hurt in terms of disruptions to their supply chains. Consumers are going to be hurt by rising costs. And ultimately, we are going to see this lead to a wave of protectionism around the world, because the reality right now is that compared to the U.S., practically every other economy is in pretty dire shape. If you talk about Europe, Japan, China, most of America's trading partners, they're not in great shape. So the notion of the rest of the world being able to get together to deepen their own trade integration with each other and leave the U.S. out, that's not a realistic prospect. So when von der Leyen talks about Europe not becoming a dumping ground for other countries' exports, I think she has in mind China, where a huge amount of excess capacity has been built up in the last 2 or 3 years, with production doing well, but household consumption not doing well. So I think we're going to see an era of protectionism that is going to sweep across the globe, with the U.S. unfortunately at the lead.
That's interesting, because I was going to ask you, at times like this, we've seen in previous times that Xi Jinping kind of likes to position himself as China as kind of the new liberal economic champions of the world, right? We've seen him go on another charm offensive, talking with global leaders, with global business heads. Do you think that is outside the realm of possibility in terms of China trying to replace that American exceptionalism story?
Ideally, this should be the perfect time for China to be able to strengthen its trade linkages with other countries, because China is already a very important trading partner for many countries in Asia, Latin America, Europe, and so on. But the reality right now is that the world recognizes that China has a great deal of excess capacity, a great deal of excess supply. China, in fact, is facing deflationary pressures because of all this excess capacity. So, for instance, if you think about the number of electric vehicles being produced in China, there is little likelihood of all of those vehicles being absorbed in the Chinese market. And this is a potentially huge problem for many other countries like Japan and Germany. unlike the US, many of these countries, including China, Japan, Germany, and so on, rely on exports a great deal more to generate growth. And their manufacturing sectors are hurting. So the prospect of increasing trade integration with China, which could bring even more exports from China onto their shores, is not a welcome prospect. So at this time, it's going to be very difficult for China to make inroads into the U.S. relationships with other countries by trying to set up, bilateral or multilateral trade relationships, because everybody fears the U.S. tariffs, but they also fear China's excess capacity equally.
Jennifer, I wanted to get your views on how you feel about this prospect, right? Because there have been a lot of people saying, well, now, for example, is a perfect time to bring China into the CPTPP, which has expressed interest over the years in joining. Do you think that is a viable sort of alternative as the US continues to retreat into more protectionist policies and kind of that sort of fundamental restructuring of US trade?
So I don't know whether joining the CPTPP is at this moment in time a realistic option for China, but there's no question that at the heart of what you're saying is that what we're going to see is a fragmentation of the trading system into various blocks. And what we know from all of the studies that we've done is that is going to be very costly, not just to the United States, but to the world. I mean, the IMF and the WTO have really looked at this and said, if we allow the trading system fragment into, two blocks, those that are sort of affiliated and trading around China versus those that are affiliated and or trading around the United States, just that fragmentation alone could create as much as a reduction of 5% of global GDP. So this idea of fragmenting into these different blocks is really going to be costly to the world.
And of course, you come from a background of serving on the appellate body of the WTO. President Trump has frequently expressed, not a great deal of regard for these international institutions. Do you expect bodies like the WTO to be able to have any influence in this environment?
I hope so, because again, I do think even if the United States has disdain for the WTO and the rules-based system, my hope is that the rest of the world does not go down this road of creating unnecessary lawlessness and chaos. So my hope is that the rest of the world sticks to the WTO and their WTO obligations and uses the WTO. The WTO could be a very useful forum in pushing back on some of the concerns about the overcapacity with respect to China that has just been spoken of. The WTO could, I think, try to prevent the worst of this going down a road where the United States imposes illegal tariffs and the rest of the world responds and we go down this very negative spiral. So it would be my hope that the rest of the world would say, wait a minute, this is too dangerous a road to go down. We are better off trying to use the WTO system and use a rules-based system and try to work out some of this through negotiations that could be done via the WTO.
And as you point out, tariffs, the legality is being questioned under both US law and international law. Do you expect this illegality to be challenged at any point, either domestically or by other trading partners?
Yes, on both fronts, I expect a challenge. Again, under U.S. law, these tariffs have been imposed under something that is called the International Emergency Economic Powers Act. And at least from my perspective, the major problem with it is it does not authorize the president to impose tariffs. In the United States, the right to impose tariffs is given to the Congress, not to the president. So the president can only act, in a very limited way when the Congress has granted him the authority to do that. And in my view, IEEPA does not grant the authority to the president to impose these tariffs. So I do believe that there will be a number of challenges domestically here in the United States with importers saying you are putting illegal tariffs on my imports. And that may result then in an injunction, meaning the court saying, stop, you cannot impose these tariffs, while this issue of whether the president does or does not have that authority gets litigated in the court. So I definitely expect that kind of domestic challenge. on the international side, we've already seen some countries start challenges at the WTO. And again, I would expect to see a lot more of those challenges where countries go to the WTO and say very clearly that these tariffs violate the United States' commitment that it would not charge any tariffs on anyone that are higher than the rates that were agreed upon in the trade negotiations. And secondly, the United States agreed that it would not discriminate as between one country or another. In other words, that all countries would be subject to the same rates of tariff. And obviously what you've seen now with this notion of these reciprocal tariffs is the United States imposing radically different tariffs depending on what country those goods come from. So I would expect, again, a whole series of challenges against the United States tariffs under those WTO rules. And I would expect, again, that panels will rule that, in fact, the United States' tariffs are a violation of our commitments under, again, Articles 1 and 2 of the GATT, under the basic trading rules around tariffs.
Eswar, back in December, you wrote a piece saying that, a Trump tariff war, or at least a tariff threat, could mean the US comes out on top, right? But a lot of those factors are stellar outperformance in US stock markets, the fact that the economy was strong and China's economy at that point was really on the back foot. Some of those factors have shifted since then, right? Do you still hold that sort of same conviction that this could be a grand bargaining tool that comes out with Trump on top?
The only way that this could be a positive, and in other words, I am extraordinarily concerned. These are very, very high tariffs that are going to have huge implications. Again, we are on the road that we were on in the 1930s when the United States Congress passed what is referred to as the Smoot-Hawley Tariff Act, that again resulted in all of this for tariffs. And that was a very negative road to be on. There's no question that the United States led Smoot-Hawley tariffs deepened and lengthened the level of the Great Depression. So we should not go back down that road. And so to me, obviously I am very concerned about these tariffs. I do not believe they should be imposed. And the issue is, what can the rest of the world do about it other than each individual country choosing their own responses and their own retaliation against the United States, which again then is just going to start this spiral. So to me, far better would be to try to see whether or not there is any way to negotiate among all of these countries some relatively better balance in tariffs. Because to the extent that there is any truth to what President Trump is saying, it is that the tariffs have become out of balance, in that the last round, the last time we had a serious negotiation where we did bargaining over everybody's tariff levels, was in the 1990s. Okay, a long time ago, when China and India and South Africa and many of the other bigger emerging markets were fundamentally not engaged in much in the way of international trade. They did not make significant changes to their tariff schedules at the time that those negotiations occurred, and we haven't had very many negotiations since then. So again, this may be an opportune time for the world to get together and say, let's rebalance where we are. Let's recognize that China is a very different trading nation than it was in the 1990s, and we need some fundamental rebalancing in the trading system.
So Heidi, in my New York Times piece that you referred to, I made the point that every country is going to suffer from the consequences of a trade war, which is clearly something that we're at the cusp of breaking out around the world. The U.S. was and is in a relatively stronger position compared to the rest of the world. China's economy is doing a little better right now. Certainly, there are some indicators that suggest that the economy is stabilizing, if not really picking up. But consumption demand still remains very weak right now. The question then is whether there are going to be greater costs on the rest of the world, but whether the U.S. can escape. And my sense is that the scale and scope of these tariffs are certainly going to have a very severe disruptive effect on the U.S. economy in terms of the greater uncertainty, which will have an effect on business investment, the disruptions to the supply chains of many multinational multinational corporations based in the US, but that use supply chains around the world, and it is going to hurt consumer confidence. And this is all happening at a time when the immigration policies and many other policies of the Trump administration are also likely to drive up prices in the United States. So we could well end up in a situation where, as we have seen, inflation is proving persistent, and the labor market, which had been doing very well until recently, might start showing the effects of a tariff war. Now, the key question, as Professor Hillman said, is what the rest of the world does about it. Many of the trade agreements, bilateral and multilateral, that the U.S. had signed are all in shreds right now. The World Trade Organization is in principle still a place that countries to turn to, but the appellate functions of the WTO have essentially been frozen because of the U.S. disengagement from the WTO. And the reality right now is that it seems to be every country for itself. And they're applying, combination of strategies, some degree of retaliation against the Trump tariffs, some degree of mollification by trying to negotiate with Trump, and diversification. But that diversification becomes a real challenge right now when every country has its economy in shambles and doesn't want to be, again, invoking the words of Madame von der Leyen, become a dumping ground for exports from other countries. So it's going to be a very difficult trading environment. And ultimately, this is going to harm business sector efficiency as businesses look more to resilience rather than cost-cutting and efficiency. And this ultimately is going to mean fewer choices, higher prices for consumers around the world, in addition to a lot of financial market uncertainty.
Stroud, before we go, I wanted to get your long-term view on how we end up, because we know that tariffs can be notoriously sticky and difficult to unwind, not to mention a lot of the other structural changes that President Trump and Elon Musk are making within the US. What do you think are the long-term implications beyond just this election cycle?
It's clear that we are in an environment where the U.S. is going to be much more protectionist. The narrative that globalization has worked much better for other countries rather than the U.S. is not fully supported by the facts, but it's certainly been a refrain that has worked very well in the political setting, and Donald Trump, of course, has used it to the maximum. So the question is how one can really foreground the benefits to American consumers and businesses, which are a little harder to discern than the pain, which sometimes tends to be localized in some industries and some communities. There is, I suspect, going to be a pushback against these tariffs as the pain filters through the U.S. economy through different sectors. Agricultural exporters are going to get hit. Businesses are going to get very hit. So I think we will start seeing the pain accumulating, and one hopes that this will bring some sanity back to U.S. trade policy. Again, as Professor Hillman said, this is not to say that Trump has it completely wrong. There are certainly some countries that have taken advantage of the rules-based system and twisted it to their advantage. So certainly we need a better system, but I think ultimately we do need a rules-based system so that it works well for everybody.
Eswar Prasad from Cornell University and JenniferHillman from Georgetown Law. Really appreciate both of you coming on and giving us your time today. Well, coming up, we take a look at the market's perspective. How do traders, investors navigate if this is the new normal? We'll be talking market strategy with Morgan Asset Management's Raisah Rasid. More ahead. This is Bloomberg.
It's the perfect entree to let's make a deal.
He's ran on this for the last 4 years, really, is that he needs to make sure that the other countries are paying what they deserve.
There was nothing truly consistent about this rollout. Each country truly is affected differently and to a higher degree than what I think many were factoring in.
I would advise none of the countries to panic. I wouldn't try to retaliate, because as long as you don't retaliate, this is the high end of the number.
It's going to be a very, very bumpy road, and we may well look back on this as sort of a knife edge of the economic prosperity of the United States for some time to come.
Well, I guess they're sharing their insights on President Trump's global tariffs announcement, and Indian markets are just coming online after Trump slapped the country with some of the highest tariff rates on any major US trading partner. Trump also says that his good personal ties with the Prime Minister Narendra Modi did not affect his decision. Let's take a look at how Indian markets are faring at the moment with Avril.
Yeah, Heidi, I mean, Trump really targeting friends and foes alike, right, with those tariffs going into place against India. But if you look at the market reaction, it's interesting, it's really not that bad compared to the likes of Vietnam or Japan. And the view that's been emerging among analysts is that maybe investors are now going to be searching for economies that are domestically driven. And then keep in mind as well that for these 26% of tariffs on India, it's still much lower than for the likes of China and Vietnam. So we are seeing declines in India, but maybe not as bad as some expected. There could also be some carve-outs when it comes to these levies, when it comes to autos, as well as pharma products. Now flip the board and take a look as well, just highlighting the moves on the rupee. We are seeing that weakness. And again, this is not as bad as what we're seeing in the Vietnam dong, which plunged to the lowest on record. That being said, the rupee that's managed gains in about the past month, thanks to some improving sentiment on India's stocks and bonds, that could now hit a wall. Now, what does this mean for central bank cuts from the RBI in particular?
Avril Hong, though, with a look at how Indian markets are coming online as we continue to see that turmoil. Having said that, a number of these markets are sort of off the steeper session lows that we were earlier this morning. But let's bring in Rasid, who's a global market strategist at JPMorgan Asset Management. She joins us now in Singapore. Rasid, really great to have you with us. And I understand, you know, as you say in your notes, you need more time to kind of do the calculations, do that modelling. The potential impact of these tariffs are so wide-ranging from geographies to sectors. To, you know, the broader macro economy. How do you kind of approach this from an investor point of view?
No, thanks so much, Heidi. I mean, the way that we're looking at tariffs, the magnitude of the impact now is very different from what we saw in 2017, 2018. And this really kind of creates a non-linear ramification across markets. I mean, what we're telling investors right now is that just remember that these tariffs are really applied on goods, not so much on services. So it means that certain markets, they're a little bit more services-oriented, more domestic-oriented. That could be opportunities for investors as well. The differential in tariff rates across markets is also create another opportunity also. But also beyond, you know, what's happening today, obviously today is a watershed moment, but there are idiosyncratic stories really happening across key markets, right? I mean, when we look at China, there is that sort of fiscal policy stimulus coming through, that openness to tech, to robotics, etc. Over in Europe, you do have that sort of fiscal space that's being curated now with defense spending. So what we are telling investors that, look, there is a need to really maintain that sort of diversified portfolio across both US equities as well as international equities.
Tell us about some of those idiosyncratic stories, right? China is an interesting one because there is the argument that, you know, with the tech-driven, AI-driven boom that's sort of taking place and the you know, even mild economic recovery, that could be a good diversifier. Or do you worry too much about that US tariff and geopolitical exposure?
Look, I mean, when it comes to China, it's interesting, right? Because they did set out that 5% GDP target growth. So there is the intention by policymakers to really push through certain fiscal support. Obviously, the domestic story in China has been weak with the sort of inventory overhang, especially in the property market. But again, that willingness for policymakers to actually meet some of the tech giants in China, that is a positive sign. I think when it comes to China, is the ability or the willingness to really roll out a lot more on the fiscal side. Obviously, we do have that July Politburo meeting coming up as well. So all eyes on that, whether there would be a lot more bond issuance happening at that point in time. And also, I think monetary policy would have to step up a little bit more so that we're talking about triple R cuts, policy rate cuts, at least through this quarter.
Broadly, though, when you take a look at sort of what a balanced or, you know, a safe portfolio looks like at the moment, would you be looking more defensive, whether that means, you know, more fixed income, sovereign bonds, gold, yen, and even sort of places like Australia that generally are a little bit safer?
Yeah, no, I think that's, to your point, that's exactly what we would be pushing our investors to do. We're also, as mentioned earlier, on equities front, both U.S. and international equities could look interesting as well, just really diversifying Japan's long-term story with the corporate governance, etc. That could look interesting. And the fixed income side, as the name suggests, right, it does give you the sort of steady income that we really need, because the truth of the matter is the volatility is going to be here to stay, and that's really going to really affect investment sentiment levels. So at that point in time, so what do? You stay invested, but where do you go? So fixed income is another one. We've seen how some of the corporate bonds it's of higher quality now. That would be interesting. Commodities as well, as you mentioned, gold, that is a good inflation hedge. And also looking at some alternative assets as well, infrastructure, transportation, and also option strategies, right? That could be an overlay and really provide you that sort of steady income, because really that's what investors are looking for in such turbulent time, which could persist at least over the next couple of quarters.
When it comes to Europe, do you see further to run when it comes to this sort of German fiscal reform and rearmament rally that we've seen?
That's an excellent question. I mean, when it comes to Europe, as you mentioned, it's really a very German-centric story right now. But the fiscal story, it's not going to happen overnight, right? It's going to be a more medium-term story, the ability to push out defense spending out of the entire fiscal budget, etc. And really, it is a very German story at this point in time. Countries like France, some of the other Western countries, Western European countries, they're pretty limited by the excessive deficit limit that is being imposed by the European Commission right now. So it does take a while to play out. We have seen that rally taken place over the last couple of weeks right now. But again, I think it's more medium-term story, and we do need more compelling structural piece for us to be very much more constructive when it comes to Europe.
Raisah, Rasid, who's a global market strategist at JPMorgan Asset Management. Really great to have you with us. Let's take a look ahead to our coverage in the coming hours of markets across the Middle East and Europe start to come online. Our Horizons Middle East and Africa anchor, Jemima Basheshe, joins us now. And, you know, most countries, Jemima, in the Middle East seem to have just gotten the sort of baseline 10% hit, but the outlook for global growth is worrying the broader region a bit more.
Yeah, Hedy, I would say that this has really come as a shock to many of the countries within the GCC region, namely because the GCC region itself doesn't actually apply tariffs on U.S. imported goods. And if they do, it's very close to 5%, not that 10% reciprocal tariff that the U.S. administration introduced last night. So definitely coming as a bit of a surprise. Now, if you want to think about the overall impact and how this may actually influence the economies of the region, you've got to think of two channels. The first, as a reminder, these currencies, GCC currencies, are pegged to the USD. In an environment where the dollar seems to be weakening, that's going to have a knock-on effect on the purchasing power of many of these nations themselves, i.e. weaker USD means weaker local currency. It's going to be a lot more expensive for these countries to import some of the goods referenced, and eventually that could be inflationary. So first impact, inflationary. The second channel, obviously, is to do with the global growth outlook and the fact that the market is shaving off the upcoming demand for oil. And that is going to have an impact on many of the countries in the region who, of course, are still very much hydrocarbon dependent. And so the oil outlook and the fact that oil today has dropped something like 2-3% is also going to have an impact on these countries' budgets. And the final point worth bearing in mind is just from a geopolitical standpoint, the region has made a lot of strides in the last couple of years to become sort of a corridor between East and West. Now they're sitting in the middle of what has become a very tense trade war between the U.S. and China, and they may have to reevaluate their own growth expansion plans for things like DP World, for example. Our Bloomberg intelligence analyst is saying they may have to reevaluate their expansion and acquisition plans on a global scale, given the news in the last 24 hours.
And the outlook for oil remains pretty messy at this point, doesn't it?
Yeah, I mean, and you see that in the price action this morning. I think it is also worth pointing out that in terms of goods, oil was actually carved out. So oil products, natural gas, energy products were carved out. They were exemptions for those goods on the tariffs. If there hadn't been, then perhaps you would have seen a spike up in the oil price, which is exactly what the Trump administration doesn't want to see. And so there are exemptions there. But what you're seeing this morning is a reaction to the big downgrades in the global growth outlook. The fact that now you have poly markets predicting a 50% chance of a recession in the U.S. What is that going to do to the demand for oil looking ahead? China, with tariff rates of more than 50%, what is that going to do to the demands coming from China and from those Asian economies too? So the oil market is focused on those fundamentals, and it's sort of at odds with some of the more bullish drivers that we've seen as of late, with the U.S. tightening restrictions on Iran, on Russia. And the fact that OPEC Plus seemed to think that this is a good time to start producing extra barrels and putting more extra barrels on the market again. But as of now, the drivers once again seem to be bearish.
Jemima Bajete there with us. And still ahead, of course, on Bloomberg, we'll be speaking live with the U.S. Commerce Secretary Howard Lutnick following President Trump's so-called Liberation Day tariff rollout. That's coming up on Bloomberg Surveillance at those times on your screen. But Iran's Middle East and Africa is coming up next. This is Bloomberg.